Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on October 24th, 2022. Reminder, we have a trading session tomorrow at 11 o'clock Eastern. Of course, as always, I'm going to review the trades and results from last week, which was quite an interesting week in the market. And I want to discuss narrow trades, Delta and United, trading airline earnings, but bringing to you some recommendations, some advice on how to trade earnings in general. We closed three trades that were put on in various periods of time: the Trade Desk, Delta Airlines, and United Airlines, and we keep on banging it out. It's the only way to describe it. The market goes up sharply, market goes down sharply. We keep, I think, chunking away would be to diminish the success that we've seen. We just keep on generating the cash that is coming in, and we keep on moving with fairly light feet, moving in and out of the market. As you can see, we had very nice rates of return, very nice amounts of cash coming in. And it was a variety of trades because of the rolls that we've had. And we've been rolling core positions. We're temporarily, and I do mean temporarily, we're avoiding things such as General Motors because they have earnings this week, and then we're going to come back in. So this focus on generating cash week by week does not mean we get ahead of ourselves. It doesn't mean we avoid events in the real world or we avoid events in the market. So last week to go was a pretty good week. We were a little bit below the week before. We're significantly above this week. And for those of you who are new to listening to this, the annualized rate of return is our metric for opening, managing, and closing positions. It's the only way to go. It's how you compare a new trade with a strike of a put that expires in 9 days. That's a $50 strike. And how do you compare that to a $100 strike for something expiring in 4 days? The only way to do that is with your annualized rates of return. And to that point, here's another look at it in terms of how we did. The roll trades at 0.5% is really good. It's important that positions we've been in for a while continue to generate significant amounts of cash, and they are. I want to add something here, and I'm going to discuss it also when we discuss Delta and United, and that is the increase. No, it's not increasing. We've been doing it now for about 6 months of moving in and out of positions quickly. One of the things I use to gauge, because I work remote, I see people twice a year. We had a great time in Las Vegas last week, and I think we're going back sometime next year. And but you get feedback going is this not hanging on, this taking smaller amounts of cash but larger, higher, bigger annualized rates of return. Is it working? My emails say it does. The personal feedback I got face-to-face last week says it does. And we had a session called the One Day Trader, which is not day trading. It's about hoping you're out in 1 or 2 or 3 days and planning to close early. And we put on 3 trades and we were all closed the next day, and we made a lot of money. So this approach in this market is working. But for those of you who are new, because I did get one email, and this is why I'm making this comment, this is not a day trading service where I start with charts. I start in the real world. How's business? And then we end up with charts, chains, and premiums, and then I close because the annual rates of return are where we want them to be. We're now deep into earnings season. This is a big week. McDonald's, Apple, Amazon, the big guys, big gals. And we're getting deeper into the impact of elevated interest rates in the economy. The bond market is now forecasting a 0.75 point increase in November and a 0.5 point increase in December. Mortgage rates last week averaged over 7%. And this is creating market uncertainty because the conclusion is between interest rates and uncertainty about prices and inflation, we're going to have a recession. And it was a very important topic that people brought to me during office hours last week. What do you think? And the bottom line is we're going to see interest rate increases in what I think will be a vain attempt to curb inflation. I think inflation is out of the control of the Fed because the nature of inflation, not that the Fed doesn't have tools for certain kinds of inflation. And they need it for credibility reasons and so forth and so on. But you have a situation where the market's uncertain. The market's never been through this. And the blurb here is, I'm not trying to be funny. There is very little, if any, collective experience on Wall Street in dealing with a real bear market, meaning a bear market driven by increases in interest rates and falling value of bonds. It just really hasn't happened over a period of time for 40 years. That's a long time. And there's a flip side to this. The market uncertainty, the ups and downs, the ups and downs, the ups and downs give us a chance to go in and out of trades and make a lot of money. So while this can be confounding for people looking for one direction, oh, I know the market's going down for the next 12 months or the market's going up, this actually creates opportunities for us. So getting to specifics, the last couple of trades. Airline earnings were strong, no surprise, but so were the forecasts. There was a continued post-pandemic recovery in revenue. An article actually today that came out from CNBC, I think it was CNBC, it might have been Bloomberg, was talking about airline prices are up 40 something percent compared to the depth of the pandemic, and we're getting near pre-pandemic levels in terms of bookings. And it's the upbeat guidance, I think, that really moved these stocks, as a lot of the success in filling the planes was in the bag. So here's the Delta trade. We put it on a Friday via alert. Was nicely out of the money. As you can see, it was more than roughly $2 out of the money, which means that seemed a lot, but that's over 6%. And the option price was well above a 1% annualized return, even if it expired worthless. And that's really, and this is what you get after earnings come out. The volatility that builds up in a stock. Oh, how are earnings going to be? Let's speculate. Let's buy some calls. Let's buy some puts. Let's hedge our position by buying puts or selling calls. That infects the chain, but it doesn't go away after the press release comes out and management has its conference call. So we captured a lot of that, and then we closed it a couple of days later. The stock had barely moved. Okay, it was up 34 cents compared to when we put the trade on, and but the premium was down by 2/3. And this is what you do. You keep an eye on this, and we had a nice profit of 23 a contract, and that's 0.8% in 5 days. It's 57% on an annualized basis. So it was well within our range. From a cash basis, 0.8% is very high. From an annualized return, 57 is very high. And this was because we could capture that volatility. Well, did the same with United Airlines. Why not? There are 4 big airlines: United, American, Southwest, and Delta in the United States. And here we have a situation which was roughly the same thing. This was almost 10% out of the money, a little more distant in the strike. But because the move in the stock had been as aggressive as it was, I sold something a little deeper out of the money and with a slightly lower potential rate of return. Now, if you take a look and see the potential rate of return was 29%, the threshold for me here is 32, but I was convinced that I was going to be closing this early and that the 29 had to be put out there for you to understand it, but it was not what we were going to realize if the trade worked as hoped. Well, the trade did. We closed it in a relatively short period of time. Again, we were down 2/3. The premium was off roughly 2/3 from where we'd sold it. Now, some of you might go, $18 a contract, why would I bother? Well, some people might do 10 contracts, or 5, or 3, or 2, or 1. But again, it's the 61% annualized return, which is the big number, right? It's the really big number. And I want to go back to the comment I made about the one-day trading session in Las Vegas last week. We put on 3 positions. We closed them the next day because of the annualized rates of return. And these are, high. These were people actively managing portfolios. They were there. We could talk about things. And one guy came up to me the next morning and goes, "Thank you. I made $8,000 on those 3 trades." Made my day to hear somebody say that face to face rather than get an email. But the in and out doesn't have to be an inhibitor. The absolute number of the dollars you make per contract should not inhibit you. it should encourage you that if you keep on doing this, your returns are going to be very high. So what are we going to do going forward? We're going to avoid, for example, as I said, earnings announcements from companies such as General Motors and Sunrun. But there are very good opportunities on the horizon. Our earnings season pretty much tapers off after the end of the first week of November, but we have earnings that go on throughout the quarter. And one of the things that I've done well, not even sporadically, I did it once or twice, was recommend good until canceled orders in the alert. So what does that mean? It's the order to buy a put right after you put on the trade to sell a put, but of course it's at a lower price, and it puts things on autopilot. And of course you can adjust it every morning over coffee, right? You put a trade on a Friday, like we did with Delta Airlines. You're going, my target rate of return is annualized 50%. This is what that means in terms of what I should pay to buy it back on Monday. And it doesn't hit that number on Monday. And on Tuesday morning, you trade the good until canceled order because the annualized rate of return changes with the length of time in the trade. And if you have more questions about it, of course, send me an email. So trading this week, as I said, big week of potentially market-moving stocks like Amazon and Apple and McDonald's. And we're going to continue to trade the core stocks for cash. Expect 1 or 2 new positions. I'd love to have a week where you could bang out 3. No promises. And we're going to put a new trade on General Motors after earnings come out on Tuesday. A lot of General Motors' current production information and anticipated sales are already baked into the stock price. The question is what management will say about chip supply chain issues, about electric vehicles, about the impact of interest rates. And just to sum up, earnings and earnings season gives us a chance to trade against the down market. So the market may have been bumpy and rough last week, but we had a really good week. And whatever you do, please don't trade before earnings. You may want to with the speculative part of your portfolio, but this here is not a speculative service. And to show you why American Express beat on revenue, it beat on profit and raised its forecast, and the stock sold off almost 7%. So even when you're right in the real world, you can still get clobbered. So please, other than speculative money, I really would avoid putting position on before earnings come out. This is Michael Schulman. Thanks for listening.